Hello, everybody. Thank you for joining us for today's webinar. We're happy to have you here, and we're happy to have David Lerman from CME Group as well. We are going to be discussing the micro E-mini options, and we're set to get started right at 4:30. We have a lot of people registered, and we will have this recorded as well on our website and YouTube channels within the next few days as well. So if you do miss something, it will be on the website shortly. So we'll just wait a couple more minutes. We're going to let everyone file in here, and then we will get started. So thank you for joining us, and just sit back. We'll get started shortly here. Thank you. Hello, everybody. Thank you for joining us today for our free webinar, Micro E-mini Options, the next chapter in an amazing journey. We are happy to have everyone attend. We are happy to have Dave Lerman of the CME Group, Director of Education, to provide us with some insights and some knowledge on some new products and give you an idea of what else is being developed here at CME and for the E-mini and for the options trading. Before we get started, we, of course, just have our quick disclosure. So if you wouldn't mind hanging with us here for one moment. Sorry about that. This presentation is for informational purposes only. Nothing presented today should be construed as investment advice or recommendation to buy, sell, or hold any security or contract. Since we don't know everyone's investment objectives or risk tolerance, we are not endorsing any specific trading strategies. Security derivative and futures trading involves substantial risk of loss and is not suitable for all investors. Each investor must consider whether this is a suitable investment, since you may lose all or more than your initial investment. Past performance is not indicative of future results. Lightspeed Financial Services Group LLC is not affiliated with these third-party market commentator educators or service providers. Data, information, and material, the content are provided for informational, educational purposes only. This content neither is nor should be construed as an offer, solicitation, or recommendation to buy or sell any securities or contracts. Any investment decisions made by the users through the use of such content is solely based on the user's independent analysis, taking into consideration your financial circumstances, investment objectives, and risk tolerance. Lion Brokerage LLC and Lightspeed Financial Services Group LLC does not endorse, offer, nor recommend any of these services or commentary provided by any of the market commentators, education service providers. Any information used to execute any trading strategies are solely based on the independent analysis of the user. Thank you for that. For anyone for more information on a demo account or opening futures or equities account with Lightspeed, please contact us here. My name is Rob Lipson. I'm the VP of Sales and Business Development here at Lightspeed. You can contact me at rlipson, RLIVSON at lightspeed.com or sales at lightspeed.com. And you can request a demo for the eFutures software powered by CQG for trading the E-mini and the E-mini options contracts as well. So you can do that through the website. So please take a look at that. We are happy to have, as I said, David Lerman from the CME present to us today, longtime futures trader and educator, and really knows the business inside and out. So we're happy to have him return and provide us with another chapter of learning here. So I'm going to shift the presentation over and let him take it away. If you guys do have questions, feel free to type them in. We'll try to get to them as we go. If at some point it doesn't apply, we'll try to come back to it if we can. Otherwise, we'll try to answer that if you always email us in the future. So I'm giving Dave the presentation here now. He should be able to share the screen, and we can get started.
All right, ladies and gentlemen, thank you very much for logging in. On behalf of the CME Group and myself, I want to thank Lightspeed for hosting us and letting us speak as part of their educational efforts. We're going to talk today about the micro E-mini options. The launch is over with. We launched it a couple weeks ago, and we have lots of commentary on it. We think that everybody will walk away having learned something on this. We have some basic information. We have some more intermediate and advanced stuff, too, for those traders that have a lot of experience on options, too. I'm Dave Lerman. I'm the Director of Education at the CME Group. I've been with the Merck about 31 years now. And I used to trade bond futures and options on Treasury bond futures at the Board of Trade before we all became one big happy family. And I've been at the Merck ever since then. It's been a wonderful, wonderful scripted career. Actually, my degree is in molecular biology. I used to study viruses. So this whole pandemic thing has been very, very, very interesting for me because I used to be an expert on these things called viruses. So anyways, I made the transition into derivatives and futures and options trading, and it's been one heck of a ride. So I've been very fortunate to be part of some of the more high-profile launches at the CME Group, including the micro futures back in May of 2019, and more recently here, the micro E-mini equity options launch. And it's been pretty amazing what's gone on. But quick disclaimer on our part, I'm not going to read this whole thing here. Just remember, futures and options are not suitable for all investors, and they involve the risk of loss. So we always try to tell people, I do it at the end of every one of my seminars, any video, do your homework. I have hundreds of emails and phone calls and records of people that didn't do their homework, and it's one heck of a train wreck occasionally what happens when you don't do your homework. So anyway, so the next step in an amazing journey. Well, on May 6th, we launched, May 6th, 2019, we launched the micro futures, micro E-mini futures. We had a little contest in our department to see who would get the closest to the hole, I guess they say in golf, who would get the closest to the volume. And the most optimistic projection was 100,000 contracts on day one. Well, we blew that away. We did about 310,000 day one. And since then, we've probably traded between 350 and 400 million contracts over the course of a year, year and a quarter. So one of the I did a lot of the launch seminars too and webinars. Back then we were able to do seminars, but now it's all webinars. And what had happened was the number one question we would get is, when are the options going to launch? Well, they launched August 31st. Good success. We wish they, had the success of the futures, but you almost never get volume in options equal to futures. Usually the volume and open interest of an options contract is anywhere between 10, 20, 30% of the underlying futures. And the underlying futures is so incredibly successful that if you get to that threshold, it's a very, very exciting contract. All right, so we launched two of them, all right? We have 4 micros, but on options, we only launched 2 of them. We did micro options, micro E-mini S&P, and we did micro E-mini NASDAQ 100. Don't ask when we're going to do the other 2. We'd like to establish core liquidity in the products that we do launch. Sometimes that takes 6 months. Sometimes it takes 3 years, 4 years. Euro-dollar futures are the most liquid financial instrument in the world, and they took 10 years to get anywhere near 100,000 in volume. But once they got to 100,000, now they're doing 2 or 3 million. Even with low interest rates, they're doing some decent volume, and there's great liquidity in them. So down the road, we would consider launching the Dow Micro E-mini Dow and the Micro E-mini Russell 2000. But right now, we're going to establish core liquidity in the 2 that have the most activity. Okay, so we have here futures. Now, I have a lot of stuff that references the micro futures, but this is an options webinar. We're talking about the options on the micros, but you have to kind of establish the infrastructure and the critical mass that's in the underlying. Because if you don't have critical mass or liquidity in the underlying, your options have very little hope of making it. I've never seen an options contract that was incredibly liquid, incredibly successful, where its underlying wasn't active. Okay, I've never seen it. It could be out there, but I've never seen it. So anyways, we have a micro E-mini futures average daily volume by month. And you can see when we first launched, we did between 400 and 500,000, a couple of spikes up there to 700,000, 600,000. Then February 2020 came, the pandemic and the volatility in the market, the wicked bear market that shaved 37% off the S&P 500 in basically 12 trading days. And you can see the volume just spiked over 2 million contracts a day. And ever since then, we've been averaging about 2 million, 1.5 to 2 million contracts a day. So we've had great success. People are pretty happy with the futures, and I believe they're going to be just as happy with the options. Here's the micro E-mini options volume. We now have some data. This goes till the middle of September. I will update this in a couple days when I get the new updates. But you can see we started out a little slow, and then we gained momentum as more market makers came on board. And we were doing, 6, 7, 8,000 contracts a day. I think average daily volume is somewhere right around 5,000, which for a brand new product that's 3 weeks old, we're happy with it. Any exchange would be happy with a new product out of the gate, trading several thousand contracts. Again, market makers, take time to get their models right and their market making activities right. It takes time for people to come on board. And again, critical mass was never established in a day or two, or even a month or two. It usually takes months, if not years. But we're very happy with the start, and we believe we're going to build on that big time. Okay, so the volume is coming to CME Group. This is all the options on S&P 500. This includes the pit-traded standard S&P 500, which used to be a thriving, gigantic contract. Its notional value is about 800,000 now, so it's so big that a 1% move is, $8,000. So it's big. That's why we launched the E-mini. The E-mini got so big, that's why we launched the micro E-minis. But you can see volume and open interest just steadily go uphill. The market share of the E-mini is now about 98%, which just goes to show electronic trading. We started it in 1992 at the CME Group, and it's grew slowly at first, but it's grown really nicely now. So the E-mini options have overtaken by a long shot the standard S&P options. And we also look for the micro E-mini options to actually contribute to this trend. So it's going up, it's going in the right direction, and we look for that to continue, especially if we get some kind of volatility. We've really quieted down the first quarter and second quarter. We're very, very violent, a lot of volume, a lot of activity due to the pandemic and the bear market and the global shutdown. And then things kind of quieted down for a while, which is normal. When you have that kind of volatility, excuse me, you can't continue that volatility forever. Eventually things have to quiet down, and they kind of go in cycles. All right, so why trade options on the micros? We have about 9 or 10 reasons. We'll go over them real quick. This webinar basically should run 40, 45 minutes, and we'll take questions at the end. If I see a good stopping point and I see a few questions, we will answer them as we go along. But we will allow plenty of time at the end to answer questions. I think we got an hour time frame here, and the seminar won't take more than 45 minutes, I hope, unless I go off on a tangent. So precision trading and scaling. All right, so you have an underlying contract now. It's 1/10 of the value of the E-mini. So traders can scale in and out of the S&P or the NASDAQ 100, give yourself a little greater precision. We'll have an example on that later. We've all traded a one lot. We bought something, and we made money, and we sold it. But you bought one, you sold one, you took your profit, but then the market, after you sell and get out of the trade, continues on up. Well, if you were a less well-capitalized trader and you had a one lot in the E-mini, you can actually do the equivalent would be a 10 lot in the micro E-mini options, giving you more flexibility to stay in the trade. We'll have an example on that later. We have a lot of versatility to add into your strategies because we have long and short-term views based on weekly, monthly, end of month, and quarterly expirations. So now you can do short-dated strategies, you can do intermediate strategies, or you can do more long-dated strategies using some of the quarterly expirations. And with the elections coming up and some of the volatility that people perceive, earnings season coming up, in October for the third quarter, people are going to want different strategies. They're going to want to be able to do the quarterlies that go out a ways. They're going to want to be able to do, weekly options based on maybe some government economic report that comes out, on a Monday or a Friday or a Wednesday. And you could do Monday, Wednesday, and Friday weekly expirations in the E-minis, and you could do Friday weekly expirations in the micro E-minis. So you can take advantage of various opportunities. Also, you access the micro E-mini futures liquidity, which we talked about. That's important. You just get a lot of critical mass from having a liquid futures contract. So you have lower premiums because they're smaller contracts, and they've traded about 400 million contracts so far, and it was one of the most successful products in history. So as a result, there should be continued growth in liquidity in the micro options. We have the clearinghouse and risk management. We really take this seriously. When it comes to the CME Group and risk management, we built our entire house around it, called the clearinghouse. And they're the ones that mitigate risk at the FCM level and the client level, and of course, the exchange level. They change margin requirements. They can collect variation margins. They ensure the integrity of the buyers and sellers on both sides of a transaction. So we've been doing it for about 170, 180 years, so we're pretty good at it. The number one reason we get people from trading securities and ETFs over to futures is the tax man cometh. It's one entity that always gets its take. When you trade futures, they're subject to the 60-40 rule, which is an arcane rule, section 1256 of the Internal Revenue Code, and it just says 60% of your gains will be at long-term capital gains rates and 40% of your gains will be at ordinary income. The blended tax bracket for someone in the higher tax brackets is like 22%. And some people say, okay, that's good, but not compelling enough. Well, if you're a good trader, this adds up. And I think we're gonna have an example later on, but when you're in the 22% tax bracket versus the 32 or 39% tax bracket if you're paid an ordinary income and you're a good trader, this could be tens of thousands of dollars every year in tax savings. And if you're a big trader, it could be a six-figure sum of trading if you're a very successful trader. So one of the nice things about trading futures is you have tax efficiencies. You also have micro and E-mini offsets. If you buy one E-mini option and you sell 10 of the same strike price and the same expiration month in the micros, you just instruct your FCM and they will handle things on the clearinghouse end, and then it'll be an offsetting transaction. So you would have a net position of 0 in that case. So you also have margin efficiencies. If you do any micro futures versus micro options, there should be some margin efficiencies. Again, it depends on your firm and it depends on exactly what's going on in the marketplace. Because if we're getting a lot of violence, a lot of volatility, margins usually go up. So be aware of that. Of course, though, when you're buying options, you pay the premium up front, and that's that. If you sell options, things get different. The margin's completely different. Liquidity. People are always comparing our futures to the ETF market. I love this comparison because it makes us look really, really good. It looks even better in fixed income or energies or metals, but it looks pretty good in the equities too. So the S&P 500, the futures complex trades about 9 times the value of the S&P 500 ETF, and about 60% more than the underlying cash basket of the stocks that comprise, the 500 stocks that comprise the S&P 500. With NASDAQ, it's about 8 times the value of the NASDAQ 100 ETF, the QQQ, and about 20% more than the value of the underlying NASDAQ 100 basket, cash basket. So that's incredible. One little futures, actually our futures contract, the E-mini S&P 500, outtrades all 7,000 ETFs on an average daily dollar volume every day by a factor of 2. So it's incredibly liquid. ETFs are a great product. I'm not knocking them. They're great. There's a lot of spreading and arbitrage between ETFs and stock index futures, but it's no contest when you compare the amount of money that flows into futures versus flows into the cash versus what flows into the ETF market. Another big thing, around the clock trading. You can do after hours trading at various firms in stocks and in ETFs. The liquidity is suspect. Sometimes it's okay, sometimes it's not okay. Futures, they've been trading 24/6 for basically a long time. And during some events like the election of 2016, Brexit, the Swiss National Bank announcement, some of the Italian banking issues, we had great volume and great liquidity overnight. We did as much volume overnight as a lot of futures contracts do during the entire regular trading hours trading day. The other reason, futures market strength, technical levels are determined in the futures, not the underlying. Most people don't realize this, but there's so much money that flows into the futures, and there's so many large players and intermediate players and small players. There's so much critical mass that most people will draw their technical analysis based off the futures. You can do the cash, you can do the ETF if you want, but many technical levels are based on the futures, and you can see it sometimes in the market action too. Okay, we also have, last comment, diverse client base. We have over 160,000 unique accounts trading the micro E-minis. That's incredible. In 1 year to get 160,000 unique accounts, that's fantastic. We have more than 75,000 accounts being first-time traders for the micro futures, and that's amazing too. To get 75,000 totally brand new first-time traders in a product is amazing. I'm sure the micros are going to contribute to that, and I'm sure they've already started. All right, so let's do a quick comparison here, okay? And we're going to look at the attributes for options on futures and options on stocks or options on ETFs. So the underlying, with option on futures, obviously you get a futures contract. With options on stocks, you get 100 shares of the stock or 100 shares of the ETF. Now remember, 100 shares of something like Amazon is going to cost you a fortune if you ever want to exercise or get assigned. Now, granted, most people don't exercise or get a sign, but it can happen. Even Tesla after it's split, even Apple after it's split, these are, still expensive stocks. So now, tick value. Stocks move in penny increments. The options move in penny or in nickel increments, depending on the size of the premium. With options on futures, that varies by product. They have different tick sizes for everything. And we're going to get over contract specs in a little bit. Expiration consideration, remember, upon exercise or assignment, you have a futures contract. Futures have discrete expirations. So if you were to exercise into a micro E-mini S&P future, it's going off the board. The September just went off the board last week. It expired. The December is the next expiration. They don't go forever ad infinitum. All right, they have a finite lifespan. They have expirations quarterly: March, June, September, and December. Third Friday, usually the third Friday of the expiration month. Options on stocks, when you exercise or are signed, stocks can be held indefinitely. Stocks don't have expiration. All right, the only time they expire is if they go Chapter 11 or there's some corporate event they're taken over or something like that, or merged. Around-the-clock trading, yes, and options on futures. And, well, options on stocks, you can have it, but you got to be well-wired, or you got to be able to put up with a decided lack of liquidity at 2 or 3 in the morning. Asset classes available, well, options on stocks, you're talking just equities for the most part. With futures, you have equities, you have currencies, you have interest rates, and you have commodities. Liquidity for both of them, it varies, depends. Some of the most liquid futures contracts like treasuries, Eurodollar, stock index futures have very good liquidity, basically 24/6. Options on stocks, most of the liquidity is during the regular trading hour day. Tax efficiencies, we already talked about that. We'll talk about it more if we have time. Yes, you have that 60-40 rule with options on futures. You do not with options on stocks. Margin and capital efficiencies, usually, if you exercise or sign and you have to go into the futures, you put up 3 to 10% of the notional value. Options on stocks, if you exercise or get a sign, you have to borrow 50% and put down 50%. When you buy options, though, you pay the premium up front, and that's pretty much it, and that's their risk. So they both have an equal attribute on that. You put the premium in an option, you pay the premium on an option on a stock, and you pay the premium on an option on future. Volatility issues, there's this thing called skew. The out-of-the-money puts in the stock market usually run a little bit higher than the out-of-the-money calls, and in some cases a lot higher, especially in equities and stock index futures. But in currencies or in treasuries or in gold, you won't have that skew. Puts and calls, out-of-the-money put and calls usually have similar volatilities. But in the stock market, things tend to go down faster than they go up. So out-of-the-money puts have higher implied volatilities over time, and sometimes it's dramatic. All right, so here's the contract spec. And you can see options on micro E-mini S&P and options on micro E-mini NASDAQ 100. I'm only going to go over one of them, the S&P for now. So MES is the futures contract, the underlying contract, the unit, MES. Just put an M for micro in front of ES, which was the E-mini S&P 500 that we launched in 1997. The tick, minimum price fluctuation. Remember, we talked about stocks and stock options being penny increments or nickel increments. With options on the micro E-mini, it's 1/4 of a point or 0.25, and that equals $1.25, and that's for premiums above 5 points. Anything below 5 points, you have a reduced tick value of 0.05, which equals 1/4. So very, very small tick sizes, very, very small contracts, perfect for a novice or a beginner, perfect for someone that doesn't have, let's just say, less capitalized, the trading hours, we start out at 5 o'clock p.m. on Sundays, and we go all the way till 4 o'clock p.m. on Friday. We're closed on Saturday. We open up again Sunday at 5 o'clock. There's a 45-minute or 1-hour trading halt starting at, I think, 3:15, and we open up again 45 minutes later, Chicago time. So we're open pretty much all the time. If something happens in Asia or something happens in your European time zone, you have recourse to put a position on, add a position, or offset a position. The product code for the quarterlies, MES. For the end of month, EOM is end of month, EX. And for the weekly options, EX1, 2, 3, and 4. We're going to have a lot of ways to explain the quarterly, end of month, and weekly options, but the best way is to show you the expiration calendar that we're going to have in a few pages, so hold off on that. In the listing cycle, we'll have 2 quarterly, 3 end of month, 5 Friday weeklies, and again, you're going to see the calendar. Remember, and we'll go over some of these things a couple of times. Quarterly expirations are American style, and weekly and end of month options are European style. This is a nuance that you have to understand because it will allow you to exercise at any time if you trade quarterly, but if you trade weekly or end of month and you want to exercise, you got to wait till the final day of trading. All right. We have a market maker program. They're doing a pretty good job. As time goes on, they'll do an even better job. Usually on day 1 or week 1, you don't have every market maker up in every time zone, but we're getting there. So the goal is to incentivize behavior similar to that of the futures, that we have good liquidity for active retail traders, even for smaller institutions or hedge funds that want to be able to trade in all 3 time zones. All right, we're going to skip this, more on the diverse menu of expirations. And yeah, here we go. Here's the calendar, nice and colorful. And it's a little outdated now because we've been launched for a couple of weeks now. But when we first launched on August 31st, this is what was available. These were the expirations that were available. So we have weeklies. Hold on a second, I'm trying to get rid of this dialog box. We have in blue, light blue, we have the weeks, all right? Actually dark blue, we have weeks 1, 2, and 4. We have light blue, the week 3s are also known as serial options. Now notice October 16th, there's an expiration. That's the 3rd Friday of October. So you would think, oh, well, there's no October futures, but there is a weekly option that goes off on the 3rd Friday. The only true quarterlies are March, June, September, and December. So you see September 18th and December 18th, those are quarterly options, all right? Everything else is weekly or end of month. And sometimes the weeklies in a non-expiration month like October and November, like October 16th and November 20th, those would be called serial options or week 3 options. I'm sorry for the confusion. I didn't name them that way, but I like serial options better. But some people get confused. End of month is very simple. It's at the end of the month. So August 31st, this is what we had listed. You can do September 4, 11, and 25th weeklies. The 18th would be a weekly, but it's really coincides with a quarterly expiration. So we just call it, 4 weeklies available, even though one's a quarter. We have the end of month at the 30th, and then we have the week 3s, October 16th, and then we have the end of month in October. We have a week 3 in November, end of month October, and we have the quarterly expiration in December. And these are all updated on our website. You can go to cmegroup.com, look at the micro E-mini options and futures, and you can see the expiration calendars. It'll give you everything that's listed. Obviously, September 4th and 11th and 18th are off the board. The 25th is going off the board tomorrow, so they will have listed all those now in October. So you'll have all the Friday weeklies in October, including the week 3s and, of course, the end of month. And then as they come off the board and expire, then November weeklies will be added sequentially. So it makes more sense to see a picture of all these expirations than it is to go over the ticker symbol and the verbiage that we had on some of the other pages. But it gives you a very diverse menu. You can do any kind of expiration you want. So look at this chart. When's the election? Well, the election is Tuesday, November 3rd. Well, you can't do anything in September to take advantage of it. You want to make sure you got your exposure going into the election in case there's some kind of surprise or something like that. You could trade a November week 3, or you can do a November end of month. Not only that, as we get closer, there will be that Friday, October 30th, Friday, November 6th. There'll be weekly options there too. But any volatility that's going to occur is probably going to occur before that. You're going to go into the last week of October and that first couple days of November, and that's where you're going to center on where you think event risk is, event-driven strategy. So you can plan accordingly. If you wanted to put a trade on now, you could put it November week 3 or November end of month or December quarterly. You'll pay more premium because they have longer time to expiration. But you get the idea. Okay, next. Here it is in color coded. You can see the E-mini S&P ES. There's Monday, Wednesday, Friday weeklies. There's an end of month and there's a quarterly. The quarterlies are American style expiration. All others are European style. Now, the micro E-mini option, the NASDAQ option, E-mini NASDAQ, and the micro E-mini NASDAQ option only have Friday weeklies, end of month, and quarterly. They don't have Monday and Wednesday weekly as of now, okay? Again, just hammering this home because there's a lot of expirations out there for a novice. It's going to get a little confusing, but once you trade these things and you get the listing cycle in your head and how it works, it becomes very, very easy. Okay, let's look now. Let's get down into the details of the actual contract. So let's compare the cost of vertical spreads in the S&P 500, the E-mini S&P 500, and the micro E-mini S&P 500. This is an illustration I did before we launched, before August 31st. Now we can do comparisons. You can go look at the premiums of the micros and see how close they are to the minis and how close those are to the standard. They should be close. If they get too far away, someone's going to spread that away or arbitrage that away. So this is a vertical spread. It's the 3270, 3370 vertical spread. It was way in the money at one point, but now the market's reversed about 5–10%, and I think we're right down near the lower strike there, maybe even below it. So it's a vertical spread, and I have it listed for the cost of the vertical spread for the three contracts: the standard S&P, the big $800,000 monster contract, the E-mini S&P, and the micro E-mini. So the 3270 call, 64.10. The 3370 call, 21.80 for the standard S&P. The cost of the spread, the vertical spread, 42.30. The contract multiplier is 250. So the cost of the spread in dollars is $10,575. A lot of money for a spread. Next column over, the E-mini S&P 500, the premiums are a little different. Well, they're going to be different. The tick sizes are different. In the S&P 500, the tick sizes are a dime, 0.10. And the tick sizes in the mini S&P are 0.25. You can never have a 0.10 in the E-mini or in the micro. So it's going to be a little different. Supply and demand fluctuations will be a little bit different. So it's 42.25 points, which is close. It's a $50 multiplier, so it's only 2,112. So you get the idea. That's a much cheaper vertical spread to put on. But look at the micros now, the last column over. Still 42.25. The contract multiplier is 5. So you'll only pay $211 for that spread. So you can see this is a great illustration. It shows a huge difference in the vertical spread cost. So if you're new to trading or you have a smaller account, the micro can give you a very inexpensive way to trade these two great benchmarks, the NASDAQ and the S&P 500. By the way, there can be no guarantee that these options will trade identically or similar to the E-mini premium, all right? They should. Again, spreaders, arbitrageurs usually like to keep things in line and, profit off that. I can't see them getting too far out of line. Otherwise, someone's going to go in and buy what's expensive or sell what's expensive and buy what's cheap, all right? Next slide, same thing. We're not going to go over everything, but it's the straddle. Just doing the 3260 straddle for August end of month option. The cost of the straddle, $37,000 for the standard S&P, $7,500 for the E-mini, and $753 for the micro. So again, it gives the smaller, less well-heeled trader a chance to trade in the market at a lower cost and therefore the lower risk. All right. So a couple things there. I don't want to go over this whole slide. There's a couple slides I'm going to skip in the interest of time. I want to make sure we have some time for questions. One of the great things about short-term micro E-mini option, you get maximum precision and flexibility. You get European style, no pin risk, no contrary assignment or abandonment. We'll talk about that later if we have time, but if you don't hold options into expiration, then you don't have to worry about this. But you can use weekly options to hedge long-term positions. You can manage your gamma risk and your theta risk. You have high theta, you have high time decay. When you have an option with 1 week to go, high time decay. But you also have high gamma. So if the market makes a big move, these options will gain. If they go in the correct direction, they will gain quickly. So you can, it's a great way to tap a liquidity pool to express a view on a very short-term market-moving economic report. Unemployment report days, the volume explodes sometimes. People are really trying to, game the employment report. It's a great way to play any kind of event-driven trading like earnings announcements, government economic releases, and things like that. All right, so here, just to give you a quick look, short-term micro E-mini options. All right, so this is using the NASDAQ as an illustration. And again, I put it together. I was doing August, week 1, week 2, week 3, week 4, and the September quarter, 2020. So you can see it's an 11,090 strike. The premium for the week 1 August was 92.25. Look at the September premium for the September quarterly, 402. So that's like 5 times the amount. Premium in US dollars, 1845, 1,845. The premium for the micro would be 184, 1/10 of value. And so even the September quarterly option becomes a lot more affordable because it's 1/10 the value. So it's $804 versus $8,000, which is incredible. So again, you have a lot of flexibility depending on what news is going to come out, what event you're looking to strategize over, and it gives you flexibility. So that's a good thing. We're going to skip that. We're going to skip that. And we're going to skip that. Sorry about that. All right. So a couple other things here before we get into the Q&A. We're going into the home stretch here. So the micro E-mini versus E-mini options, it just allows precision scaling, which is a good thing. A smaller size option contract allows traders to do scale in or scale out. It's something that all professionals do. Anyone with experience does it. It gets you in at an average cost. It gets you out at an average cost, and it could be a very good thing. All traders, they've been in the position where they buy a 1 lot and watch the market rocket higher after they offset the 1 contract. I've been there a million times. You just were a small trader, or you just didn't want to make a big trade. Well, with micro options, micro E-minis, the smaller size allows you to trade a 10 lot in the micro E-mini options. 10 MES options is equivalent to 1 ES option. The market goes in your favor, you can scale out of a few contracts, still be in the market as it continues to advance, and gradually reduce the position after that. Like I said, it's a technique employed by a lot of traders, including professional traders. So let's do an example. A trader buys 10 3,200 MES call options with the underlying at 31.90. Their trading system is based on relative strength index. This is actually loosely based on a friend of mine that runs money, and he trades a lot of RSI trades. He has other indicators, but RSI is one of the key catalysts for him. Any move below 30 in an RSI, relative strength index, generates a buy. 30 is generally pretty oversold. You can get down to 20 or even 10, but 30 means you've had some good, many days of good selling. Any move above 75 or so generates a sell or a reduction in position size. So again, you're getting overbought if you're 75 or above. Just to give you an idea, the S&P 500 recently got to 82 on the RSI before it headed down in the last few weeks. Gold hit almost 90 in its RSI, and silver did hit 90, just barely hit 90. And then look what happened. They were kind of overbought, and they had nice sell-offs now, and they've corrected 10-15%. So let's look at the chart on the next page. And you can see precision buying, precision selling. So down at the bottom panel, we have the RSI. You get a bunch of arrows there. And at the top, you have a chart. This is, I believe, a 5-minute chart of trading throughout the day. And anytime we get below 30 on the RSI, we have a buy signal. Anytime we get above 70, we have a sell signal. So we, when he started this trade, with the first buy signal he got was right around 31.94 in micro E-mini future. So he buys 10 calls, all right? Remember, the 31.90 calls, buys 10 of them. Well, anytime we get above 70 on the RSI, we have a sell signal. So we got to almost 80, actually, a couple of moments later. The market rallied up really nicely. He sells 5. That's the thing. You can scale in and scale out. You can buy 10. You don't have to sell the whole 10. You could sell 5. Okay, a couple moments later, you still have 5 left. The market rockets higher. Your RSI goes above 70 again. It goes to about 80. You sell a couple more. You wait a little bit longer. Now you're out of 8 of them. You still have 2 left. Well, the RSI goes almost to 85. A little bit later. So and then you get out of the remaining. The whole point is it allows you to get out of sequentially get out of your contract and capture a little bit more profit, just more efficient trading, more precision trading. All right, and you can do this on the short side too. Like I said, it's an illustration for educational purposes, but there's a lot of RSI traders out there. Not the perfect indicator. There are a lot of times I've seen an RSI go to 30 and the market continues to plunge. It goes to 20, it goes to 10. I watched it in treasury bonds back when I used to trade them. The RSI got to like 15 or 10 once. And this is nuts. We got to be washed out. And it went to 6. On a monthly basis, it went to 6, and that's when a friend of mine called me up. He says, we're going to have one monster rally eventually. And that afternoon, the rally started. It was incredible. So be careful. RSI is not perfect. All right, so here's how it looks on the trade. The 31.94 future settle, July 16th. The call was at 56.20. I'm just giving you a little record of how the things look. So the call went from 56.20 up to 78.70. The futures rallied 57 points, but the option only rallied about 22 points. Why is this? Well, options are four-dimensional instruments, folks. You know, precision scaling and all these expirations available. Remember, you still have the basic fundamentals of options, and that is you have time decay, you have impact of volatility, you have the difference between the futures price and the strike price. You have to juggle 4 dimensions. Options are four-dimensional instruments. You have to, you know, basically keep 4 plates in the air, as they say, keep them spinning. So why is that? We moved 57 points in futures, only 22 points with options. Well, the delta when we started the trade was 49%, 0.49. You're only going to move half as much unless you have a fantastic rally and you go deep in the money and the delta gets to be 99. But that did not happen in this case. It rallied, but didn't rally that much. So the delta was one reason why the options are not as sensitive as the futures. They're only 49% as sensitive. All right. Now that you had time decay, you had several days of time decay, and that's going to take some time, some premium off of the option strategy. So be aware of these things too. All right. All right, volatility. We're going to, I got about 5, 6, 7 minutes. I want to talk real briefly about volatility. Here's a volatility chart. You've all seen these things before. If you've seen any of my seminars, I talk about volatility in detail. And this goes to show you, you know, volatility is usually between 10 and 25, 30% for the most part. Occasionally it goes to single digits. And every once in a while it goes above 40 or 50%, like when we have a pandemic or the crash of '87 or the financial crisis in 2007, 2008, and 2009. A great chart gives you an idea of what's high, what's low, and but how does it impact options premiums? Well, that's why we do options implied volatility percentile rankings. So you can see here, these take volatility numbers, just like our SAT test scores where you get 2 scores. You get a raw score and you get a percentile ranking. If you got 790 on your SATs, you're in the 99th percentile, meaning you beat 99% of the people who took the test, and you probably went to a really good school like MIT or Stanford. If you scored in the 10th percentile, you know, you probably took the test again. Well, instead of test scores, I took volatility numbers and ranked them. So we can get an idea of gradation, a little gradient here. What's high, what's really high, and what's all-time high, or 3-year high. What's low, what's really low, what's average. And as you can see there, the 75.77 volatility represents the highest. The highest volatility traded in the last 3 years is 75.77. The 90th percentile would be represented by 24.78. The 70th percentile, 16.67. You get the idea. The lowest volatility, implied volatility in the last 3 years is 6.5%. Wow, those were the days, and I remember them too. You can buy premiums for a song. It was incredible how quiet the market was. We wouldn't move. We'd go 3, 4, 5 months without a 1% move in the market. Now we're getting them every day. So I think volatility right now is still running at around the 90th percentile. It's running around 22, 25%. So still pretty high. But the volatilities are meaningless unless you translate that into premium terms and dollar terms. So look at the at-the-money straddle at the high. 556 points. That's $27,800 in a mini, and that's $2,784 in the micro E-mini option. Look, just go down to the 90th percentile, which is about where we're at now. The straddle goes all the way down to 182 points, which is $9,124 in the mini S&P, and in the micro S&P, it's a tenth of that, 912. You can go all the way down. You can see the huge differences in premiums for an at-the-money straddle. You got to get volatility right. It's buy low, sell high, and volatility as well. So, you know, if you want to buy options in 90th percentile or the highs, you could do it. The chances of making money, I'm not saying you won't make money, but you reduce your chances, all right? If you buy volatility in the lower percentile rankings, at least you pay less, you risk less, and you got a better chance of making money. But remember, options are four-dimensional animals. You still have to worry about time decay and things like that. All right, I'm going to go another minute here. I'm going to just ratchet up forward to the key points. We're going to forget this quick strike stuff because we don't have enough time. Maybe we'll go back to it if we do have time. Key takeaways. All right, so the micro E-mini option contracts can benefit newer traders and those with smaller account sizes. All right, micros have many advantages when compared to ETFs and ETF options. Micros allow newer traders to reduce risk from two viewpoints: margin and dollars at risk. Micros offer all the great advantages of our larger product suite at 1/10 the size. Micros can be used by traders, hedgers, spreaders, and smaller institutions, and micro E-mini options traders enjoy around-the-clock accessibility. For those that are new to futures and options, micro futures and micro E-mini futures and micro E-mini options, they have to be traded from a futures account. Opening a futures account, it is not complicated. Many firms allow you to do it over the internet. I'm sure Lightspeed has a very simple way of opening an account. There may be a minimum account threshold and other requirements to trade options. Margin on futures is different than margin with stocks. Remember that. There's some little education, a little homework you're going to have to do because the mechanics of doing futures is a little bit different. Trading is very, very similar. All the technical analysis and fundamental analysis, pretty similar. Just a little bit, with buying and selling and deliveries. And you'll never want to take delivery of a futures contract. And stock index futures are cash settled anyway, so you don't have to worry about that. Any strategy that can be done with E-minis can be done with the micro E-minis, including straddle, strangles, verticals, condors, all that stuff. And given the four-dimensional nature of options, it's imperative you do your homework. All right. We have a lot of tools for people. Quickstrike is a great thing. I wanted to do a little bit of I'm going to go back in a second and go talk about Quickstrike. And daily options reports we have a lot of information for people, okay? There's two textbooks I recommend you read. The first one for sure, Options as a Strategic Investment. I have read it probably 3 times. That's how I got my basic education, but you really get your education by trading this stuff. Options Volatility and Pricing by Shelley Natenberg it's pointed more towards a professional trader, but very, very worth reading. There's hundreds of options books. In my opinion, those are the 2 best. Real quickly here, final thought. Actually, I'm going to go back to Quickstrike for a second, but success is the sum of small efforts repeated day in and day out. Robert Collier said that. Nothing wrong with starting out small. A lot of people start out small. Jeff Bezos, whom is pictured there, started out selling books. He has completely rewritten the retail landscape and become the richest man in the world in the process. So starting small is not a bad thing, and I urge everyone to, at least look at these contracts, start small, okay? Now, I'm going to go back real quick. We still got a little bit of time here, and I want to take time for questions, but I'm going to go back to the Quickstrike part of this thing. This is Quickstrike. It's an analytical tool, all right? You can put in a position, all right? In this case, you look at the red rectangular box, and there's a 3260 call. You can see 1. It doesn't say plus or minus. If it said minus, it would be a short call, but you assume a positive unless it says negative. So it's long, 3260 call, all right? The premium is $111. The volatility is 21.06 when I printed this screen. The delta is 52% or 0.52 in decimal. So it's a 3260 call. Let's look at some things. I always tell people, especially beginners, you should know a few things before you put a trade on, all right? You should be able to calculate your maximum risk. What's the maximum reward? What's the upside break-even point? How sensitive is an option relative to the underlying futures? Quickstrike will calculate all these things for you almost instantly. So here it is. Here's Quickstrike. Here's one of the analytic tools, and it gives you the Greek. It gives you, there you go, you get another rectangle, red. It gives you the delta, gamma, vega, and theta. Forget gamma for now. The delta is 52, which means it's 52% is sensitive to the underlying futures. So the futures move 10 points. This option will only move 5.2 points, all right? Vega tells you how much the premium is going to change for every 1 percentage point change in implied volatility. So Vega tells you how volatility is going to impact. By the way, you're not going to get this all in one sitting. Again, you got to do your homework, work with the Quickstrike, read the 2 books we talked about. You're going to have to get some education for those of you that don't know the Greeks. Theta is time decay, and it's negative. Anytime you're long an option, you're going to have a negative theta. So in this case, it's 0.93 negative. All right, this is points, by the way. And there's the profit loss diagram. So that's QuikStrike. It's free. It's a tool. When I started trading options a long time ago, it's thousands of dollars for options analytics software. You can get it, basically for free now off of our website. So I urge you all to go and visit that and work with the tool. And I think it'll make you, I won't make you a great options trader, but it may make you a better options trader. So that's it. We will take some questions now, and let's see what people are saying. Any questions? Can I get the book names again? This webinar is being archived, from what I understand, by Lightspeed, but Options as a Strategic Investment by Larry McMillan. Options as a Strategic Investment by Larry McMillan. It's a famous book. He sold 500,000 copies of it, which to sell, it's very thick. It's not the most exciting read. Trading options is much more exciting than reading them, but it's a great book if you want to learn. And Shelley Natenberg's Options, Volatility, and Pricing. Okay, I'm trying to open the dialog box here to read these. Commissions, anything you want to talk about commissions, talk to Lightspeed, because I cannot memorize the commissions and fees of all the dozens and dozens of clearing member firms and firms that trade. So anything regarding account opening or anything regarding commissions and fees, talk to the Lightspeed folks, okay? Yeah, for anyone that missed part or half of this seminar or whatever, they are going to archive it and you'll be able to see it again. And they have permission to send in a PDF format the PowerPoint slides to this. Okay, I usually share all my stuff with people. Any other questions? Going once, going twice. Yeah, someone wants to know, well, what about Russell and Dow? I knew someone would ask that. We don't know. Like I said, we're going to establish liquidity, get some success going in the NASDAQ, the micro NASDAQ options, and the micro E-mini S&P. And then later on, the Merck's usually pretty, aggressive in launching products and things like that. So we get enough demand and we get enough liquidity in these two, we'll probably consider launching the others. All right, well, if there's no more questions, I want to thank everybody for logging on, and hopefully we all got something out of this, and we hope that you trade the product. Feel free to contact Lightspeed or myself, and we'll be happy to help you out in the future. All right?
Thank you very much, Dave. We really appreciate it. We hope to have you back in the future, so please keep us in mind, and we'll certainly reach out and hope to schedule some more. I hope everyone was able to really get some insight on some of the new options here on the E-minis, and hopefully if anything new comes out, we'll have Dave come and teach us a little bit more. So thank you very much, everyone, for joining, and thank you, Dave, for presenting. We really appreciate it. Thank you.
You're very welcome.
Everyone have a good night. Thank you. Take care.